Good afternoon. Happy Friday. This is Shawn Labelle of the Dekker Hewett Group. It was another negative week here for global equities. There was nothing really in particular moving markets lower. We did have a bit more hawkish rhetoric out of some of the U.S. Fed officials, but this was the second weakest week of the year in terms of trading volume. A lot of people are on vacation here as obviously kids are starting school next week. So the volume was extraordinarily light. This just means that any sort of selling out there was likely amplified by algorithmic trading. So the market was definitely lower on all of that. In this week's Market Watch Weekly, we just discussed this continued conversation around inflation and that we're seeing the data really starting to suggest that it did peak in June and that it is really beginning to roll over. There was a purchasing manager index data out there on Monday. Again, that shows inflation is starting to weaken. The UN put out a study earlier in the week just in regards to food inflation. That's now at its lowest level since January. So I know a lot of you are probably getting tired of us talking about this, but it really does show that inflation is starting to roll over. So what this means now is that central banks might be able to take their foot off the gas in terms of these aggressive rate hikes that we're seeing. Doesn't mean that they're necessarily going to stop. It just means that they might be able to rein it in a little bit. Instead of seeing these outsized 75 basis point rate hikes, you might see 50. It also means they might be able to pause sooner than later. Of course, they're front end loading a lot of these rate hikes, and that's definitely what's caught markets off guard this year, and it's something that we're talking to a lot of clients about. Coming into the year, we were expecting around 3 or 4 individual rate hikes, the traditional number being 25 basis points. So you were expecting to finish 2022 at a rate of around 1%. We're already at 2.5%, and it's likely that we might see 4% by the end of this year. So there's a good stat in this week's Market Watch Weekly that just looks at historical interest rate hike cycles. We're already well in excess of what you've seen in the past 5 instances. We've already seen more rate hikes than what you normally get in 21 months, and we've only been through 4 months of rate hikes. So this is just showing that this is what's definitely caught the market off guard. So it's the aggressive stance that Federal Reserves are taking just to get ahead of inflation. They've learned from their mistakes in the 70s and 80s that maybe the stop and start strategy doesn't work. They want to get control of this quicker. So this is obviously just going to mean market's probably going to be range bound here for the near term, but it's better to get the pain done right away. And you're really starting to see that evidence bear fruit here in terms of these inflation data that, like I said earlier, it is definitely beginning to roll over. There's a couple of interesting charts in there this week that just shows also the negative volume that we've seen this month. It's been pretty interesting, and from a historical perspective, it does generally indicate that markets will move higher. So there's a couple interesting tables in there that we just encourage you guys to take a look. We'll end it there. I hope everyone enjoys the long weekend, and we will talk to you again next week. Cheers.